In this video I am going to share two candlestick patterns that you can use in your trading. But before we start, be sure to subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. Candlesticks is a type of price chart that is extremely popular among traders. The reason of this popularity is that candlesticks provide a lot of information in a very simple way. There are many different ways of differentiating between candles. Candlesticks can be divided into two categories based on their color: red candles and green candles. Red candles indicate down move in the market, while the green candles indicate an up move in the market. Similarly, candles can also be differentiated on the basis of body size. For instance, this candle has a big body and virtually no wicks. This indicates a strong upside momentum. On the other hand, this candle has a very small body and a relatively large wick. This indicates that the market is getting weak. Each and every candle conveys a message. The job of the trader is to identify the message and trade accordingly. This is where candlestick patterns come into the picture. Candlestick patterns are a set of candles that often occur in the live market. These patterns can indicate a strong reversal and provide superb opportunities to trade it. The important point here is that we will use these patterns in conjunction with support and resistance to identify our trade setups. So let us start by looking at the candlestick patterns. The first set of patterns is called the engulfing candle. Engulfing candles can be divided into two parts: a bullish engulfing candle and a bearish engulfing candle. A bullish engulfing candle occurs when a small red candle is followed by a big green candle. The important point here is that the body of the green candle should completely overlap the body of the red candle. So what does a bullish engulfing pattern tell you? Let us understand the meaning behind this. Firstly, we see this small red candle. The small size of the candle shows that the sellers have exhausted. Now the asset opens on the next candle, and the buyers push the price upwards. The buyers are so powerful that they manage to close above the body of the previous candle. Hence, this shows that there has been a sudden change in the momentum of the stock, and the buyers are ready to push the prices upwards. Therefore, our objective is to enter a buy trade above the high of the green candle. Now, let's look at a bearish engulfing pattern. A bearish engulfing pattern occurs when the body of a small green candle is overlapped by a big red candle that follows. This shows that the sellers saw the high price as an opportunity and shorted the market. The selling pressure was so high that the candle managed to close below the body of the previous green candle. Therefore, we want to enter in a sell trade here. The second candlestick pattern is the inside bar pattern. Now, the inside bar candles are the complete opposite of the engulfing candle. The inside bar is also a two-candle pattern. In the inside bar pattern, we see that the second candle is a small candle that is completely within the high and the low of previous candle. In other words, the second candle is inside the range of the previous candle. So what does an inside bar signify? An inside bar shows us that the price is not willing to break beyond the previous bar's range. Hence, it shows us that there is a tug of war occurring between the buyers and sellers. Now, our job becomes to wait for the price to break above or below the inside bar. We will buy if the price breaks above the inside bar, and we will sell if the price breaks below the inside bar. Again, an important point here is that we will not use these candlestick patterns alone to trade. Instead, we will use these patterns in conjunction with support-resistance lines. Now that we have understood the candlestick patterns, let us now learn how to combine these patterns with support and resistance. Here is the first example. Here we can see that the price is in an area which has acted as support before. Hence, we can expect the price to find support again and resume the uptrend. But we want to see a candlestick formation to enter the trade. Here is the pattern that we were looking for. Can you guess the pattern? Yes, it is a bullish engulfing pattern. As you can see, the body of the green candles entirely overlaps the small red body of the previous candle. So we buy here and keep our stop loss below the low of the candlestick pattern. We can place our targets at 2:1 risk to reward ratio. And as you can see, we generated profits in this trade. Here is another example. Here we have the EURUSD pair on a 15-minute chart. Let us first plot the support resistance level. Here we can see that the price has found support 3 times before breaking the level. Now, the price has come into the same area. So, we can expect the price to face resistance here and move lower. But we must wait for a candlestick pattern to enter a short trade. Here is the pattern. We can see that the red candle here engulfs the whole body of the previous green candle. Therefore, it is a bearish engulfing pattern. This gives us a clear shorting opportunity. So we sell the pair here and keep our stop loss above the resistance level. We can place our targets at 2:1 risk to reward ratio. As you can see, the price gave a strong down move after our entry. Have a look at this chart. Here we can see that price faced resistance 2 times before breaking above the level. And now, it has made a pullback to retest this level again. Hence, we can expect the price to reverse after hitting this level. Therefore, we wait for a candlestick formation. Now, here we see that the green candle is entirely inside the range of the previous red candle. So, what do we call this candlestick pattern? We call it the inside bar candle. If you can remember, the inside bar candlestick is a breakout pattern. Hence, if the price breaks above the high of the green candle, we can buy the pair. Similarly, if the price breaks below the low of the candle, we can sell. But in this scenario, we know that there is a strong level of support below the candle. Hence, if the price breaks below the green candle, it might face a problem in going down and reverse immediately. So, in this case, we will only look at buying opportunities. This means that if the price breaks below the green candle, we will not sell. We place a buy order above the high of the green candle. We place our stop loss below the resistance level. And we can place our targets at 2:1 risk-reward ratio. As you can see, the price gave a strong up move after our entry. This brings us to the end of this video. If you liked this video, then be sure to subscribe to our channel as we share new and effective strategies every week to help you become a better trader. See you soon in the next video.